Today our topic for discussion is gap theory. So let us start with the introduction. Gap theory. Gap means an area on a chart where price of stocks moves sharply up or down with little or no trading in between. So let us take an example. For example, if previous day's close is 10 and the next day market opens at 20. So if you see there is a gap between 10 and 20 where there has been no trading taken place. This gap is unexpected and can be due to fundamental or technical factors. So there are different types of gap to be studied. Let us go to the next slide to understand these gaps. So here I have shown 4 types of gaps: breakaway, continuation, exhaustion, common gap. We are going to discuss about each and every gap in detail. So let us start with common gap. The first type of gap that we are going to discuss about is common gap. So there are few points to remember for common gap. The first one is that it is found mostly on a congestion pattern. So congestion over here means a series of similar prices at which security trades for an extended period of time. Most of the time this pattern is seen moving sideways. The second point is that it gets filled up within few weeks. So this is the only gap that gets filled up within few weeks or few days compared to the other 3 gaps. The third is that it is seen when stock goes ex-dividend. And the fourth is that the price movement experienced neither an uptrend nor downtrend. So it does not tell you the direction of the share or of the market. So it is mostly found in between support and resistance level for a short span of time and are seen frequently on a price chart. They happen all day in an intraday chart. The second type of gap is breakaway gap, and it is mostly seen at the end of the price pattern and it signals the beginning of a new trend. So this price chart occurs when price breaks out of a congestion zone or trading range. This is a pattern which does not get filled up quickly, unlike our common gap. So this is third gap, which is called as runaway or measuring gap or continuation gap, and occur halfway through a strong trend. It is believed that stock moves an equal distance in price before measuring gap and helps us to measure the probable target area of the price move. Basically, it is found middle of the rapid advance or decline of price pattern. This is the last type of gap and it is called as exhaustion gap. It occurs at the end of a price pattern and often indicate end of prolonged uptrend or downtrend. It is traded with huge volume and signals an final attempt to hit a new high or a new low. So basically on the chart, if you see, the movement of the price is upward and then you have this gap, a little more the market moves up, then it starts reversing and the market start moving downward. Let us take a look on all the gaps. So we'll start with common gap, which is seen on the right side of your price chart. So mostly this common gap are seen on the congested area pattern and it moves sideways. This gap gets filled up quickly within few days or few weeks. Then comes our breakaway gap. So breakaway gap is always seen at the end of a price pattern and from there a new price pattern starts. Then comes a continuation gap, or we can call as runaway gap, which is seen or upward or downward trend movement and it is seen in the middle of the trend. So over here the movement is upward. So in the middle of the upward movement you see a runaway gap. So it tells you that market is going to move upward for quite some time. And then the last is our exhaustion gap, which is seen at the peak. It tells you that market is going to reverse any moment, and when you see it on the peak, the market moves a little bit more high and then it starts reversing. So this was all about gap theory. Thank you.